So economists are great at putting people to sleep, that's for sure. The next speaker is an economist, but David Bassanese has always kept me awake. He works for BetaShares nowadays, and please welcome him to the stage.
Thanks, Peter. Where's the... Oh, it's up there, is it? There you go. Thanks, Peter, and thanks, everyone. It's great to be here. Watch a large, wonderful audience. When I was told I was be speaking for 15 minutes, I recalled the Andy Warhol expression where everyone's famous for 15 minutes once in their life, and so I guess this is my 15 minutes of fame at the Switzer Listed Investment Conference. So I'll try to stick to time. I've got a lot to get through, but I hope there's a few interesting ideas out there for you. Obviously just general information. And what I'm doing, I mean, I'm an economist by background, and I guess, as you'll see, one of the ways in which, my value add now in terms of working here at BetaShares is looking at different ways of investing from a top-down global macro perspective. You can definitely invest in individual companies if you like, but if you want to invest in asset classes, invest in different regions around the world, then you can actually adopt a sort of top-down global macro strategy and use exchange-traded funds. And so before I present my ideas in terms of where to invest, I guess I need to share with you my view of the global economy. If it was all doom and gloom, my top ideas would be, run for the hills, invest in cash, and don't even consider the equity market. So basically, in terms of the global outlook, it is late cycle, not end of cycle. So I do agree with Peter. I mean, we are very long in the tooth in terms of the length of the economic expansion in the United States, and also the length of the bull market. But there's a lot of indicators suggest we're not necessarily at the end of the cycle. So late cycle doesn't mean end of cycle, doesn't mean time to sort of put your money under the mattress, but it does mean be somewhat cautious in terms of your allocations to the equity market. And so this is just one sign of that. This is what's called US weekly jobless claims. And basically, if you look at the grey areas there are US official recession. So in the United States, there's a group called the NBER, the National Bureau of Economic Research, that actually date to the month historically when recessions in the US are considered to have started and begun. And as you can see, jobless claims typically, they're one of my preferred lead indicators. They typically rise ahead of recessions, and historically, they need to rise about 10 to 15% from their lows before you could say, you know what, there's a pretty good chance we're in recession. So as you can see from that chart, they've been trending down nicely since the GFC, and at least by then it indicated no sign yet of any ruptures in the US labour market, which is pretty good news. And so again, that's one of the indicators I look at carefully. There's many other indicators, of course, but if something's going wrong with the US economy, that's one of the first areas you're going to see some trouble. The other really important thing globally is the fact that inflation does remain very, very low. Central banks are still trying to get inflation up to their targets. A lot of central banks have a 2% inflation target, even Japan, even though inflation in Japan is close to zero. And that means that they can basically stand ready to bring the punch bowl back to the party, so to speak, if need be. And so we've seen the Federal Reserve, as Peter mentioned, turned on a dime. They were raising rates for several years, and now they're actually contemplating cutting rates. They've cut rates once, and they've probably cut rates at least once, if not twice more this year. And the European Central Bank also signalling that they're going to provide a lot more stimulus to the European economy. And so these are structural issues that are driving inflation down globally, which I won't go into, but it does help, I guess, support the idea that the expansion that we've been enjoying can continue. Trade tension's always the big risk, and again, I guess I would share Peter's view here that trade tensions are a risk, but at the end of the day, Donald Trump is seeking re-election as US president, and he wouldn't do anything, I think, at the end of the day to jeopardise a US recession or a serious bear market. And as we've seen, he can turn on a dime. He can be your worst enemy one day and your best friend the next. And so, if need be, if push comes to shove, I suspect he will do a deal of sorts, or at least continue to kick the can down the road, so to speak, in a way that won't cause a big downturn. So just before I again took just a quick ETF recap. So again, BetaShares, we're an Australian exchange-traded fund manager. We have about over 50 exchange-traded funds now on the ASX, about just over $8 billion in funds under management. So in ETF, a lot of the presenters today, we're all running listed investment products that you can access now on the ASX quite easily. And just to touch on this, there are a lot of benefits with ETFs. I mean, obviously, as a managed fund, you get instant diversification by investing in a whole range of different companies. They are regulated. I mean, those similar types of regulations that protect investors with unlisted managed funds do apply to ASX, to ETFs. Easily accessed on the ASX. Unlike listed investment companies, they're designed to trade close to their net asset value. So if you buy a fund who's invested in shares that go up by 10%, chances are that you can buy or sell that ETF. The value of that ETF will have gone up by about 10% as well. So you're not getting the premiums and discounts. And as you'll see with some of the ideas I talk about today, very low cost and transparent. Lots of different choices, cash, commodities, currencies, and again, we at BetaShares have all of these types of exposures. The ones I'm going to concentrate on today are in the equity market. Very strong growth in ETPs. There are about 50 billion in funds under management in Australia now. Again, it's still a drop in the ocean in terms of total funds management industry, but as you can see from that chart, the size of the market is growing quite strongly. So I'll just grab a water actually, if you don't mind. So let me rip into it. Here's where the rubber hits the road, so to speak. Talking about investment opportunities. So I'm going to break it down into three areas: technology, quality, and income. And we've heard a little bit about technology and quality today, and I certainly agree they are standout investment ideas, opportunities globally at the moment. And income, again, we're all seeking income as well. So firstly with technology, this is the chart of the relative performance of the S&P tech sector, so the global tech sector index, if you like, vis-a-vis the global market. And as you can see, we had the dot-com bubble, most famously in the late 1990s, where things really got out of hand. But if you can see over the last 5, or certainly since the GFC, global technology has been a standout performer. So if you've been investing in a fund that's been investing in tech stocks, it will have done very, very well. And as you can see from that chart, it's been performing quite well over the last few years. But again, when you see a chart like that, what immediately brings people concerned is that a bubble? Is there a bubble forming? And this chart just shows you, if you look at, say, the Nasdaq 100, for example, in the US, the PE ratio of that index today is about 20 times earnings. During the dot-com bubble in the late 1990s, it got up to about 80 times earnings. And so a lot of the growth of tech companies, their share price performance over the last few years, unlike during the dot-com bubble, has been driven by earnings. So it's been driven by strong underlying fundamentals of many of those companies mentioned there. So again, Nasdaq, if you want low cost, if you like technology as an idea, you want a simple, low-cost way of getting access to many of these companies, one idea is to invest in the Nasdaq ETF, for example. Charges 48 basis points, 0.48% management fee. And all we do is give you access to the top 100 companies by market cap listed on the Nasdaq. And again, many of those companies are included in that index. We do have a number of other technology ideas, and I think these are all good in their own right. I don't have time to really go through them, but we have an Asian version of a Nasdaq type index, the Asia Technologies ETF. Global cybersecurity, so the top companies around the world that are involved in cybersecurity. Robotics is another one as well, global robotics. So just some ideas for you in that technology area. Quality, so again, a lot of talk on quality companies. Now you can, there's a way to quantitatively screen companies for quality, and quality is basically one of the key attributes here is return on equity. Companies that have an ability to generate very strong returns on their invested capital typically have a very good ability to generate earnings growth over time. And so that's one of the key criteria that Warren Buffett, been speaking a lot about Donald Trump today, but Warren Buffett, that's one of his key criteria when he looks at companies. And so what we've done is we've created a global quality leaders ETF that basically looks across the world and it takes the top 100 companies with the highest return on equity. We add a few other screens. They've got to have reasonable earnings stability. They can't have too much debt. But if they meet all those tests, it goes into our quality leaders ETF. And so, again, you get a lot of tech companies in there. You get a lot of very blue chip consumer companies in there, many of which have been mentioned today as well. But our approach there is to use a quantitative screen to generate those companies. And you're getting very broad exposure, like at top 100 companies or so in that index. As you can see from that chart, that quality has been outperforming globally over the last few years. So the orange line there is the quality index vis-a-vis the MSCI Global Index. And so again, just by using intelligent screens, I mean, you can, fly around the world and visit different companies and talk to them and do all that and get your top 30 companies, and wonderful way of doing it. But another way to do it also is to do a quantitative screen and invest in the top 150 and let the law of averages work out. Some will be good, some will be bad, but on average, you're probably going to get an above market return. The other thing I wanted to point out with this chart is that not only has quality outperformed, but it's also one of those areas of the market that tends to outperform when equities are doing not so well. So when equities turn down, when equities are going through a soft patch, as you can see from that bottom line there, the ratio of quality to the global markets does tend to go up. So not only are you getting something that should outperform, but should hold up relatively better at least when equities are turning down. And just on quality, we have also recently launched a quality India ETF. So again, you can get access to the Indian share market. It's one of the strongest growing economies in the world. It's actually going to surpass China in terms of economic growth and size over the last few years. But again, the typical way to get passive exposure to India is through a market cap index, the companies by market capitalisation. And often that's not a bad way of getting low cost exposure. In some areas it's not a good way. And in India, that market is very top heavy. So I think it's something like the top 3 or 4 stocks account for 30% of the market, and it's dominated by state-owned banks, for example. So we've basically gone and looked at it a different way, and we've screened for quality. So we've basically gone, what are the top Indian companies that have the highest return on equity, meeting various other criteria, not having too much debt, reasonable earning stability, and they're the companies we want to have in our index. And as you can see, that our IND ETF has actually outperformed not only global markets, because India has outperformed global markets, but it's also outperformed other more commonly recognised Indian benchmarks like the MSCI India Index. So again, the quality, intelligent screens in emerging markets, giving you access to, again, one of the strongest performing economies in the world. So the last one I want to touch on is income, and I'm sure all of you do seek opportunities for income, and I guess classically in Australia when we seek income we invest in our market. We're blessed because the dividend yield in our market is relatively high by global standards, dominated by the big 4 banks. So many of us, I'm sure, own the big 4 banks, and we have a heavy exposure to the Australian market because of the franking credits. But what that doesn't offer you then is diversification. You're not getting that global diversification. And typically when you invest overseas, you need to give up income returns. So we've gone about it in a different way, and we've basically screened companies around the world by dividend yield. So to give you some global diversification, but also give you an attractive dividend yield. My clicker seems to have stopped. Oh, here it is. So there's the last idea I'll leave with you is the Global Income Leaders ETF, code INCM. And basically, again, we've just screened for companies with high dividends. It ends up giving you after withholding tax, a return of about 4.7% yield versus the global MSCI index of about 2.5%. So again, way of getting income, but also getting some international diversification at the same time. That's pretty much it. So obviously our legal team insists I put that disclaimer in there, so I'll leave you to consider all those. But obviously all these things have product disclosure statements and whatnot. All of the information on these sort of products is available on our website. Thank you for your time.
Thanks, David.